Hello guys and welcome again to my challenge channel. So I have uploaded working capital management for the financial management topics, and also I have also uploaded the inventory management. So today in this particular lecture video, we're going to talk about accounts receivable management. I guess many find it difficult. I don't know about you, but I'm going to treat as if this is your first time hearing about the accounts receivable management. Okay? So, of course, um, I would like to let you know that English is not my primary language. So, have a little patience in my pronunciation and my accent. However, if you wanted to really, what do you call this? If you think that my expression, or if you think the way I speak is too slow, you can go to the settings of the YouTube uh, application that you have. You can select times 1.5 to make it faster, or 1.5 or 1.75. It's up to you. Okay? And also, you can turn on subtitles if you can't really understand my pronunciation. Now, let's get to it. Okay? So, for me, if I'm going to be direct, you only need two in order to understand accounts receivable management. The first one is all about the knowledge that you need on the accounts receivable management. And the second one is just a review on some of the formulas. Okay? So let's start with number one. There is number three, the analysis portion. Okay? So let's start with number one, the knowledge that you need to have. On the accounts receivable management, normally, you are just faced with one question. Are you going to relax your credit standards, or are you going to make your credit standards stricter or more strict? I don't know. I don't care. Or stricter. I guess that's stricter. So that's the question. Are you going to relax the credit standards, meaning you don't care about your customers' credit, what do you call this, image? You just give them an opportunity to buy products or services from your company on credit. Okay? So you have stricter credit standards in which you will have to be picky about your customers, and you will have to exert more collection efforts. Both the relaxation and the stricter credit standards has both advantages and disadvantages. So let's talk about that, because that is the number one focus. The focus of the number one that I have told you. Okay? So, as to relaxation of standards, later, let's have the stricter. For example, you think that your credit standards currently is so relaxed, so you wanted it to be strict. So what will happen? Of course, there are disadvantages and advantages. First, disadvantage if you are going to be strict is first, loss of sales. If you are going to be strict, that means some of the customers will be lost. They will go to the option where the suppliers, if ever, or the creditors, like yourself, has a relaxed credit standards. Okay? So you expect loss of sales. And of course, on your part, you will also lose some sales. It is because you'll be strict in selecting the customers that you are going to extend credit. Okay? So loss of sales. The second one is if you become stricter, you will have higher collection cost. Okay? So, first, before you extend, for example, a credit to a certain customer, you will do some extensive credit investigation, for example. That entails cost. Okay? The credit investigation could be part of this collection cost. And aside from which, for the existing customers that you have, credit customers that you will tend to give, for example, discounts. Like for example, instead of not giving discounts currently, you're going to offer 5, 10, and 30. So this discount is a disadvantage on your part because if the customers will select to enjoy this 5% discount, then that will be a loss of revenue on your part. Okay? And on the existing credit customers also, sometimes instead of following up on the payments that they missed every month, since you are going to be strict, you're going to follow up, for example, every day. Of course, doing that kind of activity entails cost. Okay? So, those are the disadvantages of being strict. Okay? So, there is loss on sales and greater collection cost. Okay? Now, there are also advantages on being strict. So, for example, lower bad debts expense. Because if you're going to be strict, for example, you have an extensive credit investigation, the bad debts expenses, which are those receivables that are doubtful to be collected or sure that it will not be collected, will be lessened. Lower bad debt expense. Of course, there is also what do we call as lower opportunity cost or uh, carrying cost. Of course, the intangible ones that could not be measured is faster collections. So let's label it as intangible. So those are the examples of the disadvantages and advantages of a stricter credit term. So let's talk about this first. What is this, sir? So if you have faster collection, they are related. So for example, you decided to have a stricter credit terms. What will happen is that the average receivables that is maintained in your company will be lessened. Like for example, from 2 million, it will become 1 million because there is a faster collection. Okay? So if that will be the case, you will save something, which is what do we call as opportunity cost. What will you save? So instead of having to carry the accounts receivable of 2 million, you are just going to carry 1 million. So there is a difference of 1 million. So such 1 million is actually, if ever, it can be invested in other ventures. Okay? So meaning, since it can be invested in other ventures, it will earn. That is why it is called opportunity cost. So lower accounts receivable, that means more for the investment. So this is what do we mean by lower opportunity cost or carrying cost. Okay? Now, later on, we will emphasize that on the relaxation of standards. Like for example, we're already through with the stricter, let's go to the relaxation of credit standards. Are there disadvantages and advantages? Of course. So, what is the disadvantage here will become the advantage here. Like for example, greater sales. Because if you tend to relax your credit terms, many will be able to uh, avail your credit, the credit option. For example, you're not so much um, conducting a very extensive credit investigation. Of course, this will become bigger. And aside from which, um, you are extending your credit term. For example, instead of N30, you put there N70. So meaning, the due dates are extended. So it will always result to greater sales. Okay? Now, aside from greater sales, one of the advantage is the saving of collection cost, uh, savings, savings on collection cost. Okay? And of course, the disadvantages are higher bad debts expense, and of course, higher opportunity cost, and slower collections. So those are the disadvantages. But I promised you a while ago, let's talk about this opportunity cost in detail. Like for example, you chose to relax your credit standards. So what is the result? The average receivable from 2 million, it became 4 million, 5 million for example. So is there an increase? Yes. There is an increase of average receivables that you have to carry. And the more you have receivables, the less you have for investments. Supposedly, if we get the difference of 2 million and 5 million, we have 3 million. If you stayed in your current credit standards and you did not relax, then this 3 million should have been invested already, earning some interest rate or dividend rate. So, if ever in the problem, there is a realization like this one, from 2 million, it became 5 million, there is a 3 million increase. However, in the problem, it was also mentioned that there is 80% cost ratio. So what is the meaning of that? And before we go to that, what is the meaning of this 80% cost ratio? Because this is the twist, and you have to remember this. What if there is an opportunity cost of 12% or the carrying cost is 12%? So here in the Accounts Receivable Management, the opportunity cost or carrying cost is expressed at 12 is expressed at percentages. Okay? So what will happen is that in our logic, we have 3 million difference, and if we did not relax, we stayed in our current credit standards, this 3 million should have earned 12% already, which is 360,000. If I'm not mistaken, that's 360,000. That is not the opportunity cost that we are looking for. Okay? What we're looking for is 3 million, the difference. You have to make it clear for yourself. Okay? This 3 million is with markup already. If it is with markup already, then that is not the ones you are going to multiply with the 12%. Okay? So, what will you do? Of course, you find the cost ratio. The cost ratio is the percentage without markup. Do you get me? So, we need that 80% cost ratio so that we can already multiply the opportunity cost rate or the carrying cost rate of 12%. And how much is that? So you have 300, 300, 600. We have 2.4 million. Okay? So this 2.4 million will be the ones that will be multiplied 12% by 12%. And I don't know how much is that. 240 divided by 5. Let me have my calculator. 400 times 0.12 is 288. So that's the opportunity cost that I'm talking about. So that's the twist. Okay? Now, when solving for problems related to accounts receivable management, what I do is actually, first, I will analyze the current credit standards. Like, I would compute the sales here, the budget's expense if ever, the collection cost if we have, everything will be analyzed here in the current credit standards. Okay? Now, when we go to proposed, so on the proposed, in the problem, it could either be stricter or relaxed. But whatever it is in the problem, there is an advantage versus disadvantage. Like for example, if the proposed is to be relaxed, okay? So if to be relaxed, then the advantage of that the disadvantage is higher budget expense. So I will compute the increase in the budget expense. Okay? I will compute the increase in the budget expense. I will also compute the opportunity cost, just like what we did here. And of course, you cannot quantify these lower collections. Okay? And the advantage, of course, there is an increase in sales. Of course, if there is an increase in sales, there is an increase in cost also. Because when you do sales, especially if you are in the business of selling goods, there is always cost of sales. So the sales is an advantage, but there is also a disadvantage on cost. Okay? And then, aside from which, I will also put the savings in collection effort. Savings in collection effort. Because again, you are going to relax. And after which, I will compare the advantage and the disadvantage. First, I will total the advantage. Next, I will total the disadvantage. And then, advantage minus disadvantage, there will be a net increase or decrease. So if this is positive, then we go to the proposed. Okay? But if the disadvantage is greater, so that means advantage minus disadvantage, it will become negative. Of course, we have to reject the proposed, what do you call this? Proposed relaxation of credit standards. So that's it. That's the first one that you need to understand. So that's knowledge based. How about number two? Number two that you need is you have to review on two things. The first one is the receivable turnover formula and the age of receivables. Or in other books, that is called collection period. So why is it? So let's spell out first the receivable turnover. Receivable turnover is credit sales. If you can still remember. Credit sales over average receivables. So for context, as if you don't understand the receivable turnover, let's have the given. Like for example, credit sales is 10 million and that the average receivable is 1 million. Then we have 10. Okay? 10 turnovers. I don't know how to, yeah, turnovers. Okay. 10 turnovers. What does it mean? On the average, your customers in a single period of operations, like for example, you are operating for 360 days in a year. So in 360 days in a year, your customers in the average are uh, enjoying credit from you. They are, what do we call this? You're extending credit to your customer and then they are going to pay. And then you're going to extend credit again. That's one turnover. And since we have 10 turnovers here, that means you extend credit, the customer pays, and then you extend credit again, one turnover 10 times. It happens. It happens in your 360-day period. So that's the meaning of turnovers. Okay? So that is much more beautiful if ever you're going to compare it with the age of receivables, in which, if you still remember, if you started your financial management journey in financial statement analysis topic, you will already memorize that this age of receivables or collection period is number of days of your operations. For example, 360 days. But sometimes it's 365 days. So for example, 360 days, number of days in a period, or number of days in period of operations, for example, 360 days. And then we have the receivable turnover, in which case, and in this case, we have 10. So you have 36 days. Okay? So what is the meaning of that? You extend credit you extend credit to your customer now. After 36 days, they will pay, and you will again extend credit to your customers on the average every 36 days. So that is why it is also called collection period. It is because you extend credit now, you'll get paid 36 days later. Okay? So those are the two things that you need to understand in order to solve problems on receivable management. Okay? So the third one is analysis. Of course, I have to write two problems, I guess. Yeah, two problems, so that we will apply what you have learned in number one, which is what are the advantages of the relax and the strict and how to solve it. And of course, the number two, which is your knowledge in the receivable turnover and the age of receivables or the collection period. Okay? So the analysis is, again, I repeat, I'll have to put two problems and let's answer it using the number one that I have told you and the number two. Okay? So I'll be right back. Alright. Here's the illustrative problem that we are going to use in order to analyze. Okay? So again, I have already told you about number one. That's knowledge about the advantages and disadvantages of relaxation of standards or and the stricter credit standards. Okay? So we will use that number one in the computation for this one. And number two, I've already told you also about, again, a review on receivable turnover and the collection period or age of receivables in other books. So let's use those things to answer this question. And let's go to the question. So BBG company's budgeted sales for the upcoming year is 40,500,000, of which 80% are expected to be credit sales. So the current collection period is 30 days. So that's the current credit standard. The current credit standard's current collection period is 30 days. Okay? And BBG operates 360 days in a year and has the following expected data because it's still a budget. So the collection cost is estimated to be 500,000. The budget's expense rate is 5%. So since this is silent, let's treat that one as 5% based on the credit sales. Okay? So actually this is not my problem. I have copied this problem in the internet and I don't know who is the original author of this one. Now, the budget's expense rate is 5% based on sales and the cost ratio is 80%. So meaning the gross profit ratio is only 20% because the cost ratio is 80%. Now, the opportunity cost in percentage is 15%. So that means the lesser accounts receivable that you have, then you have the opportunity to invest it in other investment opportunities and it will earn On the average 15% per annum. Because the problem is silent, this is per year. Okay? Now, there is a proposed relaxation of standards. And the effects of this proposed relaxation of standards is that, number one, the credit sales will increase by 20%. Number two, there will be an increased collection period up to 40 days. So this is to be expected because you are going to relax your standards. So meaning, the customers will not pay immediately. Sometimes, most of those customers will tend to extend the credit terms as much as possible. So, as you can see, the collection period from 30 days, it became 40 days. Okay? And then the budget expense from 5%, it has increased to 10%. And of course, it is to be expected since you are going to relax your credit standards, your collection cost will be decreased to not by, to 200,000. So those are the effects. And then we are now going to compute what if the proposal is pushed through. What will be the net advantage or net disadvantage of such proposal? Because based on that, we will make a decision on pursuing the proposed relaxation of credit standards or not. Okay? Now, it seemed like the problem is well arranged as to before and after the proposal. The given before the proposal is effected and the effects after the proposal. So, let me warn you, sometimes there are problems just like this one, as if it has been enumerated, it has been narrated like this. But sometimes there are problems that the given are, what do we call this, mixed. So this credit sales will be put here. It will be rumbled. All of the information will be jumbled. But even if it's the case, if you know that your style is understanding first the current credit standard policy, what happens to that versus if the proposal is effected, then you will not be lost. Okay? So, let's now start with the current policy. Again, the current policy, you have first the sales. How much is the sales? That's 40,500,000. In which there is a cash sale, which is 20% by the way. It's because it's mentioned that the credit sales is 80%. So automatically, the cash sales is 20%. Now, if we're going to compute the 80%, let's compute the 80%. Where is my calculator? $40,500,000 times 0.80. You will have a credit sales of 32,400,000. Okay. Now, let's compute for the 20% for the holistic analysis. Even though for me, this is not really important in the accounts receivable management and our problem. So, let's just compute 40,500,000 times 0.20 and you have 8,100,000. So, we are interested in this figure only. Okay? Now, how about the other things? Like for example, the collection cost. So this is important. Is 500,000 here, right? And then we have the budget expense, which is 5%. We can already get the amount because we have already computed for the credit sales. So 32,400 times 0.05, yeah, 0.05 we have 1,620,000 as the bad debts expense. So the cost ratio is 80%. I guess it will not change even if we talk about the proposal, and the opportunity cost is 15%. So we have to remember that, because it's important when we compute for the advantage and the disadvantage for the policy. Okay? So basically, this is it on the current policy. However, there is one thing. The collection period is actually 30 days currently. 30 days? Yeah, it's 30 days. So, that's it. However, you have to extend this. How to extend the analysis of that? I told you that you have to have the receivable turnover, and you also have the collection period, which is this one, or the age of receivables. So, what are the formulas again of this one? The first one is the credit sales. So, we have 32,400,000. You use that. And then, the average receivables, which we don't know yet. So, why is it we really need to analyze these two? Because sometimes we need to find these average receivables. Because we need to compare on the current policy versus the proposal, how much is the difference of the receivables? Okay? So, that's it. We need to compute for the receivable turnover and the collection period for the purpose of getting the average receivables most of the time in this particular topic. Okay? Now, we have 360 because it's given in the problem, but it can also be 365 in the computation of the collection period, right? And we have the receivable turnover. However, we have already 30 days here. Now, if you are going to solve for the receivable turnover, you just have to 360 days for shortcut. Um, if you don't want to have a long solution by means of algebra, you can immediately have 360 days over 30, and you will get 12. Let me confirm. 360 divided by 12, ano, 360 divided by 30 days. You have 12. It's right. Okay? So meaning, if this is 12, then the receivable turnover also is 12. And you do the same. In order to get the average receivables, 32,400 divided by 12, we have average receivables of 2,700,000. Let me repeat that again. 32,400 divided by 12, the receivable turnover, we have 2.7 million. Okay? So in the current policy, we have 2.7 million. Let's do the same with the proposed. On the proposed, let's start with the sales first. So on the sales, no. Let's not have the total sales. Credit sales, because according to the problem, credit sales will increase by 20%. So not the total sales, the credit sales only. So meaning, if 32,400 will increase by 20%, so that will be multiplied with times 1.20 or 1.20. Yeah, again, 32,400 times 1.20. And you will have 38,880,000. So that's the first one. And the collection cost, according to the problem, the collection cost will be reduced to 200. Yeah, to 200. And then the budget expense will become 10%. So 10%, a while ago, in the current policy, we have 32,400,000 times 5%, 1,620. In here, we have 38,880 times 0.10. So, from 1,620, it will become 3,888,000, the bad debts expense. This is for 10% already. Okay? Now, the collection period basically becomes 40 days. 40 days? Yeah, it's 40 days. So, we have to compute like this one. So, you have receivable turnover. Instead of 32,400, we're going to use the new sales, 38,880, divided by average receivables that we don't know yet. And then we have the collection period or the accounts receivable, uh, age of accounts receivables. We have 360 again. However, we don't know yet the receivable turnover, but the collection period is 40 days. So we can just 360 divided by 40 days. You have 9 receivable turnover. So this is also 9. The receivable turnover is also 9. So 38,880,000 divided by 9, and you will have 4,320. Yeah, 4,320. And as you can see, it increased. Now, in other problems, it's not only the question of net advantage or net disadvantage of the proposal. Sometimes, you will be asked, how much is the increase in the receivables? And in this case, from 2.7, it became 4,320 minus 2.7. The increase is 1,620. Sometimes, the question is all about this one. But since we wanted to appreciate the whole problem, it's not only that one. We have to have the ultimate question. What is the net advantage or net disadvantage of the proposal, which is a proposed relaxation of standards? Okay? Since we have already the comparison of data, then on the proposal, I said, you have to put the advantage and the disadvantage. Okay? So maybe you have already memorized this. So let's erase that one so that we can compare. Okay. First, on the relaxation of standards, you have an advantage. You have a disadvantage. So on the advantage side, of course, the credit sales will increase, right? So from 32,400, 38,880 minus 32,400. So there is an increase of 6,480. Increase in sales, 6,480. But then again, even if the sales increase, the company is of course will have a disadvantage because there will be an increase in cost also. Because when you sell services or goods, there is always cost of sales, cost of services. Okay? So the cost ratio is 80% if I'm not mistaken. A while ago, that's 80%. So that means 6,480 times 0.80%, and you will have 5,184,000 as the disadvantage. Okay? Now, aside from the cost and aside from the sales, you have the collection cost. From 500, it became 200. So there is a net advantage of 300,000. Collection cost savings. So that's an advantage. Right? So, next is we have bad debts expense. On the bad debts expense, you have 388,000 instead of 1620 if we are going to follow the proposal. So, there is an increase on bad debts expense, which is a disadvantage. Increase in bad debts expense of how much? The difference of the two, which is 2,268,000. Okay? So that's the bad debts expense. And lastly, we have the increase in the receivables. So that is a disadvantage because there will be an increase opportunity cost because you invested more on the receivables. Instead of investing 2.7 only, you invested for 320. Okay? So how do we compute again the opportunity cost? You start with the increase in AR, in which the increase in AR is 1620. But then again, you need to remember this 1620 is with markup. Of course, you are selling that to your customers and your customers are being collected with cost plus markup, which is why your accounts receivable is 1620. And even if it's not said explicitly in the problem, we have to get the markup. So how do we get the markup? By multiplying it with the cost ratio, which is 80% times cost ratio, which is 80% or 0.80. So we have 1620 times 0.80, 1,296,000. So that is the receivable without the markup. Okay? Now, if we have this already, that will be the ones that will be multiplied with the opportunity cost rate, which is again, I guess, that's 15%. As far as I remember, that's 15%. So 1296 times 0.15, you have 194,400 or the opportunity cost. Because of investing more in the accounts receivable, you have forgone a profit of 194,400. Yeah, that's it. I guess that's it. Now, let's compute for the total advantage and the total the total disadvantage. So we have 6,480 minus 300,000. You have 6,180. The total or the gross advantage. Whereas the disadvantage starts with 5,184,000 plus 2,268,000 plus 194,400 opportunity cost, and you will have 7,646,400. So that means the answer will be negative because the disadvantage is much greater. It is maybe because of the higher cost ratio, which means even if you have sales of 6,480, the cost is also greater. It's 90%. It's 90%, it's 80%. So the markup is only very small. And the excessive bad debts expense, because from 1,620 it became 3,888. The opportunity cost is very small only compared to the budget expense effect and the, the budget expense. So we will have minus 6,180 minus 7,646,400. We have a net disadvantage of 1,466,400. Disclaimer, I might not have computed perfectly. There might be some wrong pressing on my calculator, but The message is clear here. How do you solve or compute? You just have to tally the advantages of the proposal and the disadvantages, and you compare it, and if ever there is a positive net advantage, then you push through for the proposal. But if the disadvantage, just like this one, is greater, then maintain your current credit policy. Okay? So that's it for receivable management. Thank you for watching. And the next episode for this series will be the cash management. Okay?